I'm a corporate tax partner here in Grant Thornton, Sydney office. I'd like to welcome you all joining us for a tax debrief session. I know you've just sat through a fascinating session run by Hugh Remington with Emily and Saeed, talking through some of the commercial implications of last night's budget speech and also looking forward in terms of how to take advantage of the budget announcement and the concessions that were provided. Today, we're going to run through some questions and answers. We've been getting questions coming through during the course of the day. So please feel free to type in your questions. You should have I think a chat box or a question box there for you. So please send them through and we'll look to get through as many of them as we can. Luckily for you, I'm not doing this all by myself. I'm joined today by two of my fellow tax partners here in Grant Thornton, Australia. First up, Himashini Wiratni is a tax partner here in the corporate tax group in Sydney as well, specialising in financial services. And I'm also joined by Yan Wong, who's a corporate tax partner in our Adelaide office. And Yan also heads up our tax technical group across the country. So thank you, Himi and Yan, for joining us today. We're going to start the session off by asking Yan just to give us a quick snapshot of some of the key tax measures that were announced in last night's budget. So Yan, over to you.
Thank you, Vince. This was a fairly hefty budget. I mean, if you look at it, the 2021 deficit is approximately $161 billion, and the budget deficit for next year is $100 billion. In it, the government had to respond to a number of things, including the pandemic, the Royal Commission on Aged Care, and various issues around health and childcare. In a way, tax measures sort of slid under the radar a little bit, but having said that, there are a number of measures in there which I've highlighted here. So one of the big ones that will affect over 10 million Australians, taxpayers, is the extension of the LMITO for another year to 2022. That's about costing about an estimated $7.8 billion. The other big tax measure is targeted at corporate or business more than individuals. And that's also the extension of two measures: the temporary full expensing of costs for depreciating assets and the separate loss carryback measures. Both these measures are being extended to 2023 and will cost approximately $20 billion. There are a few other measures of interest which I put on the slide. Some for small business who are under debt recovery action from the ATO. They can go to an independent umpire in a less costly and less legalistic process, being to the AAT. There is a first extension of the amount available to be withdrawn under the First Home Super Saver Scheme, up to $50,000 from 1 July 2022. And there is a proposal to modernize the tax residency rules for individuals by applying the 183-day test as a bright line test by itself, instead of mixing it up with the other 3 residency tests. So there's some of the measures, tax measures, that I thought were of particular interest. In addition, I'd also like to remind people of 2 other sets of measures that were brought in prior years, which have been left broadly untouched by this budget. Firstly, the introduction of the 25% corporate tax, the base rate entity tax rate for companies with an aggregated turnover of less than $50 million. In my view, that's welcome tax relief for a lot of small to medium enterprises. And finally, a reminder that individuals, whilst not specifically receiving tax cuts per se other than the LMITO, will still be able to enjoy the benefits of prior year tax cuts through the raising of the ceiling on various brackets. The next big jump will be in 2024, when the top marginal tax rate pushes up to $200,000 and the introduction of a 30% rate. But because that's in the future, I've really focused in this slide on the ones that will impact the 2022 income year. So with that, I guess covers some of the major tax measures that came out. We might then turn back to you, Vince, on the broader Q&A.
Before we get into the Q&A, Himi, is there anything you want to add? Any other comments that you want to include before we start getting through the questions?
Yeah, thanks, Vince. So I'd like to sort of broadly capture it from a commercial point of view. So this year, the budget we wanted to see needed to have a fine balancing act between sensible fiscal management and a growth agenda to further support businesses, boost foreign or any other investment for that matter, and create jobs. Now, we heard Josh F say yesterday, Australia is coming back, keep the economy moving. So clearly, the key budget measures were mainly around maintaining economic growth to support the National Recovery Plan. So from what we saw, as Jan mentioned, the upshot in the raft of budget measures was to tip the dollars into the economy through personal tax cuts, remove unnecessary, costly and outdated compliance, promote and retain IP to encourage foreign investment flow, and to push business to undertake capital spending for a bigger profit in the future. You saw, as Jan mentioned, the CapEx, the extension of the CapEx and the loss carry forward rules. Now, from a tax point of view, this shows that the Treasury's assessment is the business investment is important. But if I put my tax practitioner's hat on, I think large-scale tax reform might be on the back burner for now.
Thanks, Himi. I suspect you're right. I think the hands are full with providing concessions and helping the economy navigate it through the post-COVID environment. We've got a few questions which have come through, and I'll go back to Jan with a couple of the first ones. Jan, in a nutshell, you've kind of highlighted a couple of things, but please reinforce what's in the budget for business. You know, what are the two or three key issues that business will be looking at and going, this is going to help us, this is going to work for me?
Yeah, so as per the previous highlight slide, the big one is the extension of the temporary expensing for asset costs. Government expects that the extension itself would add or would cost approximately $16 to $17 billion. You wouldn't have thought just extending a measure by a year would have that big an impact, but it actually does. Some people say that purely accelerates or brings forward spending. And look, the nature of it, that's probably true, but it accelerates it by quite a bit. So an immediate write-off now, as opposed to expensing over 5 to 6 years, or even 10 years in the case of certain other long-lasting assets, in my view, whilst temporary theoretically, is actually a fairly substantial upfront benefit for business. The loss carryback rules are also extended. They're expected to cost a bit less, about $2 to $3 billion, but they're still noteworthy for a lot of SMEs out there. Bear in mind as well that these measures, certainly the expensing of assets, applies to businesses with turnover up to under $5 billion. So you're talking, they say in the budget papers, about 99% of business will be eligible for this. So they're really the main corporate initiatives. Vince, obviously the 25% tax rate will help, but as I said, that's targeted at what we call base rate entities, which is those with turnover of less than $50 million.
Look, I think certainly just in thinking about it, looking at some of my clients, I think the loss carryback measures have been very positive and has been quite popular and has assisted a lot of business to work their way through some of the difficulties in dealing with COVID. And I guess the question will be there, Jan, we have countries across the world that have loss carryback measures permanently in place. I think the UK is one of them. And whether there's any thought about whether this extension of 12 months should actually become permanent.
Sorry, look, I think there's a case for that, Vince. Yeah, so I mean, we'll see what happens. But I think the concern is, of course, that we don't want to have too much of revenue leakage. So the government's really walking a fine line. On one hand, they needed these measures to help the economy transition over the withdrawal of JobKeeper in particular. So on the other hand, as I said earlier, we're looking at a debt of currently of $640 billion going up to $980 billion in the forward estimates to 2025. So you can only do so much, and the government really has a serious question as to where they best target those dollars.
Thanks, Yan. Himi, I might move to you. And you talked about, relating some of Josh's comments last night about getting business going. In a post-COVID environment, obviously we want to encourage growth of the Australian economy as much as possible. And foreign investment is a big part of this. What are the announcements or incentives that are released that may assist in this, help the economy grow, and to encourage some foreign investment to also help the economy grow?
Yeah, so based on what we heard yesterday, so as I said, to get the economy back up again. So their main priority right now, the government's priority now, is to encourage foreign investment. So if you look at the current tax system or the tax administration system, it's far too complex, tedious, and not easily understood. So I think their thoughts are around to make Australia a desirable destination for investment. They're thinking more along the lines of efficient, streamlined processes and simpler measures. Now, one of the things that I thought was very interesting was the ATO, they are aiming the ATO to introduce a new early engagement service to encourage and support new business investments into Australia. Now, this will provide investors with fast-track tax advice on transactions. Now, the detail was not included in the formal budget papers themselves, but when I looked at the information sheet, they have said that the services will include upfront confidence to investors about how Australian tax laws will apply, be tailored to the particular needs of each investor, and accommodate specific project timeframes and other time-sensitive aspects of transactions when you look at your FIRB applications. And where binding advice is preferred, it will also incorporate access to expedited PBRs and advanced pricing agreements. Now, this is a lot of expectation on the ATOs, from an ATO's point of view. So I would like to hear from the ATO how they're going to introduce or manage this. Now, these services apparently will be available for eligible investors from 1st of July 2021. Now, another one is, I think another step forward is establishing a more efficient licensing regime for foreign financial services providers. So again, we are still waiting for that detail. Another one which the government has introduced, that they are looking at undertaking a review into the tax treatment of venture capital vehicles. Now, this review will be undertaken to understand how the tax concession, when they're looking at particular vehicles, how it actually works. Now, most of these vehicles that they are looking into are venture capital limited partnerships, early stage venture capital limited partnerships, and Australian venture capital funds of funds. But the idea is to actually, by doing this, Australia would improve incentives for angel and venture capital investors. So again, the devil is in the details, so we are still waiting for the details around that. One of the things that usually the budget measures do, and we see year in, year out, when they do give these budget measures, are the when the government updates the list of the jurisdictions that have the effective information sharing agreement with Australia. So the updated countries are Armenia, Kenya, Mongolia, and Montenegro, and Oman from the 1st of January 2021. So as you may be aware, these type of residents investing from these countries get a 15% withholding concession rate as opposed to 30%. So these are the major measures that I saw that the government has introduced to sort of influx the foreign investment flows.
Thanks, Himi. While you're on a roll, last night there was a lot of talk around supporting digital economy and some concessions, incentives around developing Australia's IP. Can you quickly highlight those and I guess give us a view as to whether you think what's been suggested is enough to get that moving?
I think we are all in agreement. In the past, Australia has struggled to provide the right stimulus, encouragement for R&D and investment in IP. because as technology and IP becomes more dynamic, our systems, I think our systems need to incentivize and keep this IP onshore. Now, as a step forward, the government has introduced this patent box tax regime. I know everybody's talking about it. So what they have introduced is a 17% concession rate as opposed to a 25 or 30% to offer a competitive tax rate. So this is to start from 1st of July 2022. Now, the target area, funnily enough, is the Australian medical and biotechnology patents, and they are saying that they will extend it to clean energy sector. Now, this is strong, but need to provide more. I think we need to provide more incentives to commercial and protect Australian IP and extend to other sectors as well. So now, if you look at Australia, we are the forefront of IP development, and we have many leading brilliant minds across many industries. So I work with a lot of fintechs and neobanks and a lot of technology companies. And if you talk to them, they obviously complain about how hard it is to raise capital, and there's lack of support when you're commercializing activities. So it's fundamental for any sector that it should be reinvigorated. The Australian economy should be reinvigorated to keep up with the pace and the market expectation and demand. And as Emily said in this previous session, we have the opportunity to do that right now and ride that wave. So to do that, the government needs to review the current R&D system and make it easy and advantageous to develop and retain IP in Australia, and also consider the OECD-based erosion profit system to be compliant with the patent box regimes, which are now offered in other countries, and think about those alternatives as well.
Thanks very much, Himi, for the detailed responses on both areas. We're getting lots of questions come through, but please feel free to keep shooting them through, and we'll try to get through as many of them as we can. Yan, I'm going to go to you with a couple of questions. One, we've spoken about the loss carryback, and one of the questions that's come through is the loss carryback actually giving a net benefit to a taxpayer, or is this just a cash flow timing measure? What do you think?
Yeah, so probably that, because if you think about it, well, if you use your losses backwards, you're guaranteed. So you save some tax now or whenever. But if you try and carry it forward and you suffer a change in, say, ownership or same continuity of business, you might lose that loss forever. So a bird in hand, in some ways, is worth more than the bird, two birds in the bush, or sort of to mix my metaphors. So yeah, look, I get the argument. It's a timing issue, but I do think in some cases there might be permanent or certainly cash acceleration benefits from these measures.
Thanks, Yan. We're also getting a bunch of questions around super guarantee, and the question that's popped up a couple of times is, did the budget confirm if the super guarantee contribution rate would increase from 9.5% to 10% with effect from 1 July 2021?
Yeah, it did, and there's, I think, further talk of extending that up to 12% in the next 2 or 3 years. I'm not quite familiar with the precise timeline. It's in the budget, but yes, it did.
Thanks, Yan. I'll open this up to both of you, and I'll throw a bit in. Questions have come through on the patent box, and our thoughts on the expansion of industries that will be covered by the patent box. And I think, Himi, you may have mentioned it, and we've certainly spoken about it, and we've covered it in our Grant Thornton budget report, which was issued this morning. We certainly feel that there is a benefit in expanding it beyond medical and biotech. We think that what we want to do is encourage the manufacturing industry here in Australia, and to do that we need to support R&D and provide some concessions. So Himi, do you want to weigh in on that one? And then Yan, if you have any comments after that.
So I'm sure everyone who knows me that I'm very passionate about the financial services industry. Working with the fintechs and neobanks, I think it is paramount that we sort of offer it to them as well as an industry sector. But knowing how, we are actually targeting a specific generation of millennials who are looking into investing into a lot of different technological advancement, and to do that and protect that IP. And I did watch this Q&A session on ABC a couple of weeks ago, and there were so many youngsters who were talking about protecting IP in Australia and not taking it into other countries. And given that, I think it should be expanded to all sectors. That's what I think.
Look, just to add, I think the issue now for me is that this is an example of government picking winners. So with biotech and medical, it's very easy to see that that's innovative and clever and should be promoted. I guess the question then becomes, well, what about people in agri? I mean, don't they have clever IP there as well? So you could extend this to a lot of different areas where IP generally would benefit from the 17%. The question is, how much money does government want to put into it? Which sector? How do you gatekeep and make sure that the 17% isn't abused? They're looking at, I think, clean tech, clean energy. I think that's a great one. But beyond that, it might be, the lines might become a bit blur about what qualifies as truly innovative versus something that's just incremental.
Look, I think you raise a couple of good points, Jan, but I guess I'd also then point to overseas experience. Other jurisdictions that have had the patent box running for quite some time, and I think it's shown there that these things can be managed without being abused, and that it does provide a net benefit to the economy. So, I think I probably sit more with Himi's camp that we'd like to expand it. We're getting a few questions around the loss carryback, which is no surprise because I think it is an important facet of the current tax system and certainly in the post-COVID. So, Jan, we've got a question just coming through. How can we simply explain how the loss carryback provisions work? Does it mean that businesses need to amend previous year's returns? How does this play out?
So I think there's disclosures in your current. If you're claiming the losses in the year of loss going back, you disclose it in that loss return, and the ATO will work out your entitlements to refunds. So there's disclosures in the loss year return, I believe, that allows you to do that.
Thanks, Jan. I'll throw to Himi, and I think all of us have spoken about it already, but the question of tax reform, we spend a lot of time talking about reforming the system to make it more efficient and supporting Australian business. In light of what's been announced last night and whether there is actually capacity for some serious tax reform, given the budget deficit and the like, what do you see the future of some real tax reform taking place in the near future?
Yeah, Vince, that's a really good question. I think we are all in agreement that in the past, Australia, I mean, if you look at it as with any budget, there is a tendency with all budgets and federal budget process to focus on the short term, as you very rightly said so before. The point is that real tax reform is not achieved by tinkering at the edges. The government should and must see that it's fundamentally reforming tax system while at the same time supporting the economy through post-COVID-19 recovery is really important. Now, at this point in time, this cannot be overlooked or forgotten. Look, our current tax system, if you look at it, is layers and layers and decades of successive governments adding new provisions and ideas on top of existing provisions. And it just ends up being, you actually lose the policy intention behind it, and it ends up being very complicated and convoluted as well. Now, I feel like when you look at, since I've been practicing for the past 15 years, I feel that they haven't properly considered the interrelationship between the different parts of the law, or the impact economic activities and behaviors, or if you look at it, the ever-evolving organization structures or types. So I think there are a lot of sort of reviews being undertaken as to what to do next. But if you look at it, I think first and foremost, they should take a holistic approach and review the entire Australian tax system. And then secondly, look at an economic reality that individuals and business operate in a commercial environment that crosses borders domestically and internationally in ever-evolving landscape. And as I said, with different organization types. And the biggest issue is to simplify the Australian tax system, repeal ineffective taxes, which will free up resources in most organizations and save them cost and time in terms of compliance. Now, a very good example, as Jan mentioned earlier, there's two base tax rates, like 25% and 30%, and it actually not only has issues when you look at the franking system, it also adds complexities for investment. So as a government, they should conduct a large-scale review of tax administration system. So we saw that in this budget this time, but adding another layer of dispute resolution or early engagement with the EHO may add more complications. That's what I think. So as I said again before, the devil is in the detail, but we just have to wait and see.
Thanks, Himi.
Yep.
Jan, I'm going to throw it back to you. We've got a couple of questions that have come through on matters you've spoken about. One is the 25% income tax rate for turnover under 50 million for 2022. Yep. Does the turnover income apply for international corporates or Australian entities only?
So it's an aggregate turnover test. So if you follow through the definitions, it looks like basically global turnover. So it stops obviously a huge multinational from having an Australian subsidiary with less than 50 mil turnover in Australia from getting that rate. It is a global test, and that applies for that 25%. It also applies, I think there are other questions around the asset write-off as well, the 5 billion. That's also a global turnover test.
Thanks, Jan. One more question's come through, and I think you alluded briefly to it at the start in your summary. What's in the budget for individuals? You know, the money in the pocket in terms of tax rates or tax concessions.
Right.
What is there for individuals to look for too? Yeah,
the main thing is the extension of the LMITO by another year to 2023. That's 2022. That's 1,060 per individual to 1,080 per individual earning between $43,000 to $90,000. Then it scales back and cuts out at 120. So that's a nice little amount when you lodge your 22 return, which you were not prior to the budget going to be entitled to. I think the non-budget measures, if the government commits to the tax rates, not just obviously for the 21 year, which is locked in, but also the 22 year, and particularly the next tranche for post 1 July 2024. If the government has the money to commit to that, and it's then I think that would be, not tax reform per se, but a substantial benefit to a lot of individuals earning up to $200,000. So that's great. And I think the thing that's a bit of more for non-residents or people flying in and out, which obviously is not happening in this COVID time, is the red line or bright line test of 183 days to determine Australian tax residence. Now, obviously, when nobody's traveling, you're either in or you're not. So, be very clear whether you're in here for 183 days or not. So that one will be, I think, quite useful going forward once international travel starts resuming and more people are affected by it.
Thanks, Jan. Got a question that's come through again on superannuation. What impact do we see of the removal of the $450 superannuation threshold causing? And specifically, do we think that this will cause compliance risks to smaller business? And I'll have a crack at that one first. And if you guys want to add, I can see that there may be some challenges, and talking through with some of our fellow tax partners last night, things like hospitality industry and stuff like that, where there's a lot more of a casual workforce, we can see there might be some challenges in complying with the new rules now that the threshold has been reduced. So I do see there's going to be some issues with maintaining appropriate records, and that's obviously going to be a challenge for small businesses more so than anyone else. Himi, Jan, any further comments on that?
Look, I think from my point of view, I agree. I mean, I can only imagine how difficult it is for small business as it is in COVID times to deal with the red tape. Adding this on for maybe a number of casual employees, etc. From the business point of view, a small business point of view, I think would be quite frustrating. But I get the fairness argument, and to make sure that employees, casuals and the like don't miss out on superannuation.
Thanks, Yan. A question's come through whether there was any impact on tobacco excise rates in the budget last night. And Yan, I think we just chatted about it and we didn't see anything that had popped up during the course of the evening. Is that right?
Right, that's right. So normally they're hidden well, not hidden, they're contained in the treasury measures under excise, obviously. Didn't see anything in the budget. Reading through it last night, didn't see anything in the press. Usually it's beer and ciggy taxes up or down depending on the headline. In this case, beer excises went up, the cap went up, so it's good news for beer producers. Nothing about cigarettes, so I'm assuming that means there's nothing in there on that.
Great, thanks, Yan. I've just realised that we have gone over time, so we still got a couple of questions. I'm sorry if we didn't get through all of them. If you have any questions, please reach out to any of us or reach out to your GT advisor, and I'm sure they'd be happy to help in clarifying any of the matters for you. Just one last thing, and Himi, and we've spoken about it already, and maybe in the yes/no answer, the tax reform seems to be a big question that keeps popping up in terms of making the system more efficient, cutting red tape, and making it easier for business to do business. And the point was made that tax reform seemed to be missing from the budget. And when do you think this will come back on the political agenda? So if I can get a never, soon, and maybe later, or anything like that, it'd be great to get a final word on that from Himi and then from Yan.
I think from my point of view, as I said, in my experience, as far as I'm concerned, it's always a tinkering around the edges. As I said earlier, it's never this overhaul of the whole tax system. That I would like to see one day, but I don't think it will be anytime soon.
Likewise, there's too much debt out there. The focus will be, I think, on budget repair after the election. But right now, I don't think there's any appetite for root and branch reform. And besides, we already have the Henry report to dust off if people really want to pursue that. There's a number of ideas in there that haven't yet been adopted, which could be used going forward.
Thanks, guys. I'd like to thank both Himi and Yan for standing up and helping us out today, dealing with your tax questions. As I said, if you have any more questions, please reach out to any of us or reach out to your GT advisors. It's been a busy couple of days for us. Hopefully you've all received copies of our GT budget report. If you haven't, please log on to the website and download. I can assure you it is a good read, and I have no personal interest in that. We've been running through a number of sessions. As you know, we had the main webinar earlier today. We have the tax session, which we've just held. At the same time as this session, we had a couple of industry sessions dealing with manufacturing and incentives to encourage growth in the Australian economy. And we also had a special industry session dealing with health and aged care. We'll be following this up with a number of different podcasts and special topics dealing with aspects of the federal budget. So please look out for those and contribute to those and listen into those. If you enjoyed any of these sessions and want to go back and revisit, look at some of the questions or the like, all of today's sessions have been recorded and I think are going to be available on our budget microsite on the GT website. That's it from me. I want to thank you all for joining us today. Please reach out if you have any questions and look forward to speaking to you again soon. Have a good afternoon.